First talking about the markets, even though the stock market was strong, it had some headwinds earlier in the day from a run-up in long-term interest rates. We had a spike in yields early this morning in reaction probably to the economic data. The stock market seemed to shrug it off, but not so the gold market. Gold prices tanked about $20 early this morning. Silver prices were down, I think, 40 or 50 cents. Those markets seem to be the most impacted, although other commodity prices continued to rise. Look at the price of oil, up another $1 a barrel today, or just over $1. But not just oil. Commodities across the board continue to move. Lumber prices up another 2.5% today, hitting a new all-time record high. In fact, lumber prices from where they were last year are up fourfold. They've quadrupled in price in a year. Now, yes, you're comparing it to a very depressed level that existed briefly in March and April as we locked down and everything collapsed. But even if you look back to where lumber prices before anybody had even heard of COVID-19, if you look at where the price of lumber was then and compare it to it now, you're still looking at a triple in the price of lumber. So you can't look at that and say, well, it's all based on comparisons with these artificially low benchmarks, because I'm ignoring that artificially low benchmark and just comparing the price of lumber today to where the lumber was before anybody heard of COVID. And the reality is, there's no end in sight to this rally. As long as the Fed keeps printing money, and in fact, as long as the Fed keeps interest rates anchored at zero, which means mortgage rates stay low, housing demand is going to continue, even in the face of rising lumber prices. So all that means is houses are going to be more expensive to build, therefore they're going to be more expensive to buy. That means people are going to have to take on even more debt, but prices are going to keep on going up. And a lot of the increase in commodity prices is, of course, what is driving the pickup in bond yields, because the markets are still convinced, despite what Jerome Powell is reassuring the markets still believe that the Fed is going to be forced to raise interest rates much sooner than it is telegraphing it will. And it is pricing those expectations into the gold and silver market, because everybody on Wall Street believes that rising interest rates are bad for gold and bad for silver. And so they are selling gold and silver now in anticipation of higher interest rates later. But they're not selling other commodities for the same reason, because they're looking at other commodities and thinking that they're economically sensitive. And so they're thinking, we've got this booming economy, so that's great for lumber, that's great for copper, that's great for all these other commodities, but it's not good for gold and silver, because those are monetary metals, and so they're going to respond to the higher interest rates that the Fed is forced to impose to cool down this hot economy. So ironically, the commodities that you would expect would benefit most from inflation, gold and silver, are the ones that are benefiting least. Some people say it's manipulation. Government or banks are manipulating the price of gold and silver. After all, why else wouldn't it be rising? There's all this money printing. There's huge budget deficits. The price of all these other commodities are going up. What would explain gold and silver not going up? It must be manipulation. Then you have the Bitcoin crowd saying, you see, we told you so. The reason gold isn't going up is because no one cares about gold. Bitcoin stole its thunder. Bitcoin is the new gold. It's better than gold. And so why buy gold when you can buy Bitcoin? Neither of those explanations are true. The reality is, this is the market. If the big money doesn't believe that inflation is a serious threat because they believe the Fed will be able to put out the fire before it really gets started, if they really think we have a booming economy, which is what everybody seems to think, and if they believe the Fed that inflation is going to stay anchored at 2%, and if it gets too much above 2%, well, they've got the tools to bring it back down. So if you really believe we've got this booming economy and we don't really have an inflation problem because the Fed is going to contain it, then this market action makes sense. But ultimately, the markets are going to prove investors wrong. They're wrong in believing that the Fed is going to be able to successfully fight inflation. In fact, I think they're wrong to believe that the Fed will even try to fight inflation. Inflation is going to win by default because the Fed is not even going to step into the ring. They're going to surrender, and so inflation wins without a fight. And ironically, too, under that scenario, bonds will be even weaker. Yields will rise even higher at the long end when the markets actually understand how much higher than 2% the inflation is likely to get. But that's when gold's going to go ballistic. And I don't know when that's going to happen, but I believe there's going to be a very big move in the price of gold and silver in a single day. And the only way to make sure you don't miss that day is to be invested before that day. And because we don't know when that day is, we need to be fully invested now. Recognize that what is happening is just noise, and it is simply extending the buying opportunity. For how much longer, nobody knows, so don't press your luck. Just get all the gold and silver that you want to get and just buy it now. You can buy physical if you're worried about third-party storage. If you're worried about having it with an ETF, take physical possession and buy yourself some physical gold and silver. And if you really want to participate in the boom, get some exposure to the mining stocks, because these things are going to deliver far greater returns if the price of gold does what I think than the metal itself. You have tremendous leverage to the upside, and I think the upside risk is small relative to the upside potential. So you have an asymmetric bet where it's really skewed in favor of how much you can make relative to the downside if you're wrong. So if you're a gambler, this is a smart bet to make. And I think the way to play it is with my gold fund, so that you get diversification and you get professional management of your gold portfolio. And that's Adrian Day, who is managing the Euro-Pacific Gold Fund. Now, some of the economic data that has come out over the past couple of days that should be moving the price of gold and silver higher, but have not as of yet, are number one, the record merchandise trade deficit for March was $90.6 billion. That's 1 month. This is an all-time record. In fact, it's the first time we've ever had a monthly trade deficit, merchandise trade deficit, with a 90 handle. And you know what? This record is probably going to be broken in April and then broken again in May. In fact, I think before the year is over, we are going to be printing $100 billion monthly trade deficits. And this is especially going to be true if the price of oil continues to rise. Now at $65 a barrel, I think, and I've been saying, there is a very good chance that oil hits $100 a barrel before the end of this year. And since America is now back to being a net importer of oil, as the price of oil goes up, that automatically drives up our trade deficit. And so that's going to help power the deficit above $100 billion. Now, the most amazing part about the trade deficit is that nobody reported on it. I mean, nobody even cares, right? This is nothing as far as the financial media is concerned. And in fact, the few media outlets that bother to even mention the trade deficit, they don't even mention it as if it's a bad thing. I mean, they generally put a good spin on it because they say that it reflects our strong economy, right? We have this great economy. It's so strong. Consumers are buying all this stuff, and that's why we have a trade deficit. But it actually evidences the opposite. If we really had a strong economy, producers would be making a lot of stuff. We wouldn't need all these imports because our strong economy would produce the stuff that we're consuming. It's because our economy is so weak and is incapable of production that we're so reliant on stronger economies abroad to produce the stuff that we can't. Now, where are Americans getting all this money to buy all this stuff that they can't afford and didn't help produce? Well, they're getting it from the Fed. The Fed is printing up this money and mailing out these stimulus checks or unemployment benefits, and then people are taking that money and they're just buying stuff that's coming in from other countries. And you can see that in the trade deficit. The trade deficit is proof that we don't have a strong economy, that we have a bubble economy. This is evidence of a massive problem, yet everybody ignores it. Now, yes, this number, the trade deficit, is going to directly subtract from GDP, but there's still a lot of GDP that is generated on top of all these imports because the imports have to be distributed, right? So once the products come into the United States, there is a lot of economic activity in the retailing of those products and the delivery of those products that feeds into the GDP. But you take away the imports and all the rest of it falls apart. Without the underlying products, the rest of it is meaningless and goes away. So this thing is pure bubble. And ultimately, and not too far in the future, the dollar has to collapse because we are flooding the world with dollars. And how long is the world going to keep flooding America with their consumer goods in exchange for their dollars? After all, the rest of the world wants this stuff too. Why put it on ships and send it to America in exchange for dollars that are going to collapse? So this shopping spree is going to come to an end.